Hello, everyone, and welcome to Leading Indicator, a show by Public.com, bringing you insights from the world's best macro minds. I'm your host, Kyla Scanlon, and we are here today to discuss net liquidity and its impact, plus a breakdown of historical Fed pivots. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep up with the latest investment news. Today, we are here with Andy Constan, founder of Damp Spring Advisor. Andy is the former chief strategist at Brevan Howard and previously worked as an idea generator at the world's largest hedge fund. He is also the former head of equity derivatives at Salomon Brothers. Andy, welcome to Public. Yeah, thank you so much. So today we're just going to talk about the Fed. We're going to talk about a framework that you put together. But to start off, I, of course, want to start off this conversation around inflation. So we're going to have an update to the Personal Consumption Expenditures Index later this week. PCE, as we all know, is a very important indicator for the Federal Reserve and how they choose to manage monetary policy. You mentioned in a tweet recently that disinflation, bringing inflation anywhere close to the target that the Fed has for inflation is optimistic. So in your mind, what are your viewpoints regarding inflation, considering the extremely tight Fed policy that we have and their rather uncertain path forward?
Sure. Well, I think inflation is coming down. That's fairly obvious. Was much higher, and it's on its way down. The question is how far down it will go. Goods disinflation has occurred. Rent disinflation is going to occur, but services inflation remains well above target, and that's going to keep the PCE well above the Fed's desired level. Even when you look at their dot plots, where they predict PCE will be between, I think, 3.6 or maybe it's 3.9, or versus regular. In order to get that, the PCE prints that we're going to get tomorrow, Friday, need to come down quite a bit, quite quickly. And there's just nothing in the pipeline that would suggest the PCE is going to miss expectations so badly as to deliver on what the Fed's desired level is. So they're going to be higher for longer.
Mm-hmm. Yeah, it's sort of wild. The United States has managed to have economic growth while getting inflation somewhat down, but still inflation is not anywhere where anybody wants it to be. It's just a really fascinating environment right now.
Sure is. Yep. It's all that matters, it seems.
Yeah. Well, and with that being said as well, so, throughout this period of high inflation, the Fed has raised rates pretty aggressively. And the target rate is now between 5 to 5.25%. And you've highlighted a lot, this push pull between fiscal and monetary policy. So government spending versus what the Federal Reserve is doing as a driver for this growth and this inflation that we're experiencing. So with that in mind, do you think that this fiscal backdrop is why the Fed strategy, the Fed messaging isn't working?
Yeah, I think it's really the past fiscal policy that's been the what's kept the labor market tight and inflation well above target. During the 2008 to 2020 period, quantitative easing happened and there wasn't inflation. The Fed had 0% interest rates and there wasn't inflation. And that's because fiscal really didn't pull its weight in terms of increasing both of those things, both growth and inflation. And during COVID, they certainly did, and probably went too far. Certainly a couple of $1 trillion too far. And that's still working its way through the economy and showing up in very large savings pools, including bank deposits and money market funds. And so that represents liquidity at some level that can be used for asset purchases or consumption, and just keeps cycling through the economy. And that's really the residual of very large fiscal spending. However, the deficit isn't coming down. The deficit's increasing from a low of, call it last fiscal year, is going to be higher this year than it was last year. Even with the agreement to raise the debt ceiling, it looks like we're going to run a 1.4 to $1.5 trillion deficit. And part of that is because of increased interest expense that we're paying. And that's stimulative. That money is printed by the public sector, financed by issuance, which that has its own way of working, but then ends up in people's pockets to spend. And so, yeah, I think you still, though the fiscal impulse is no longer strong, it remains supportive to the economy and inflation.
Mm-hmm. Yeah, and you said in a recent note too that we really have to pay attention to Janet, not Jerome, right? So Janet Yellen, Treasury Secretary, versus Jerome Powell, Chair of the Federal Reserve. So could you talk a little bit more about, you were just talking about fiscal liquidity, but could you talk about balance sheet liquidity? So the Federal Reserve either rolling assets off the balance sheet or letting them mature, or selling them directly. How does that work within the
Sure.
economy?
So the idea of quantitative tightening is to have the Fed reduce its balance sheet and the uh, investor population have to pay the Fed by buying those bonds. In the UK, they sell the bonds into the market. And so the central BOE has bonds, and now the public sector, the private sector has bonds. The transmission mechanism in the United States is different. It's runoff. It means that the Fed just has bonds mature. And when those bonds mature, it doesn't do anything. It just takes the payment and destroys the money, essentially. But somebody has to pay them for it.
Mm-hmm.
And that is through issuance. And so Janet, Secretary Yellen, manages what type of securities are used to generate the money they need to pay back the Fed. And so it matters what she chooses.
Yeah. Yeah.
And so just to finish that off,
Mm-hmm.
for the whole year, the debt ceiling has meant that there couldn't be any new debt issued. And that resolved in June. And what happened in the first quarter and into the second quarter is money that had been borrowed in the past was used to pay off the Fed and to generate the spending that was done.
Mm-hmm.
And so the TGA, which is the federal government's checking account, came down without any issuance to fund it. And that's stimulative and sort of offsets the quantitative tightening because they pay off the Fed with bonds they've issued in the past.
Mm-hmm.
Now they're raising the TGA, building their checking account by issuing about $1.2 trillion of securities in June and in Q3. And that issuance should suck some liquidity out of the system. But the liquidity that really matters to asset prices and to the economy is whether Janet issues treasury bills or issues treasury notes and bonds. And what she's chosen to do is issue most of the new money, a little over 800 billion of it, in T-bills, which are highly liquid, which there is significant demand coming out of money market funds who are currently invested in the reverse repo program of the Fed. And so it's a very easy way to issue a lot of bonds without issue a lot of obligations to pay back the Fed and to fund the deficit and to raise the checking account without leaving a mark on asset prices. And you're seeing that asset prices have still remained pretty buoyant, even though there's a tremendous amount of issuance happening.
Yeah. But that sort of, when investors see that, that messes up the shape of the curve, right? So like that impacts how liquidity moves throughout the market, which gets into sort of how you're thinking about net liquidity. Is that right? Or am I drawing too many parallels?
The net liquidity is an equation that people use. I don't really focus on that equation. It's part of my toolkit. But what matters to that equation is what happens to bank reserves and whether bank reserves are being consumed. What matters to me is whether risk capital is being consumed, and T-bills don't tap anyone who's taking risk. they're 1 year bonds. No, people know when they're getting their money back. They don't have much market risk, and they can plan for a 1 year time when they have their money at risk. Versus a 30-year or a 10-year bond, where you have market risk. If you have 2 years from now, you experience a need for that money, and so tapping the liquidity that is the risk taking liquidity of the market, to me, is what's really matters to assets. And right now, they're not demanding investors take on a lot of risk. They're doing the opposite. And so there
Mhm.
really is very limited transmission of the quantitative tightening that the Fed is doing.
I see. And so because the Fed, because that's happening, investors are not having to take on a lot of risk. That is working against the Federal Reserve's fight with inflation because financial conditions remain relatively loose. Is that sort of what's going on?
The Fed just talked on a on a panel today, and
With the
Treasury,
ECB?
uh,
Yeah.
which was fascinating. And they think that the financial conditions that they follow are tightening. I don't agree with that and don't see it, except the real interest rates are fairly high, but credit spreads are very tight. Equity prices are at, making new highs. And the 30-year bond and 10-year bond are very low relative to short-term interest rates, meaning the curve is heavily inverted. And that isn't, to me, those are the long-term interest rates are the ones that mortgage people that are seeking a mortgage, people that are borrowing to consume, companies who are considering building or buying a factory. Those are the ones that are impacting economic activity, and they're very low. And so I would say that the conditions are quite easy, and the Fed seems to disagree with me.
Yeah, it definitely seems like everybody's looking at different data points sometimes in terms of how they come to their conclusions. And if you think about, we were talking about interest rates a little bit earlier as well, and then sort of talking now about quantitative tightening, and it seems like neither one is necessarily doing the job to get inflation down. But the Federal Reserve, at their most recent meeting, decided to pause rate hikes, or maybe pivot to not necessarily a pause. What are your thoughts around that?
Yeah, I think they have a lot more work to do, and they're playing sort of games a little bit. Like, if like back when they were hiking 75, they decided to hike 50. And there's a messaging, like they don't want people to assume that they're done. And so then they went from 50 to 25, and there was that same messaging. And 25 to skip is the sort of message that they clearly wanted to give, because the dot plot said, and Powell and everybody else has said, they see one, or today he said as many as two in the next two meetings, hikes. They're just trying to manage expectations. And by actually saying they will skip a meeting, to me, doesn't indicate anything more than they're getting closer to done than they were. And the inevitable thing when you are getting closer to done is you slow your pace. I think that's a mistake, because I'm probably a bit more hawkish in terms of the need to use the Fed's tools to tame inflation. But that's a reasonable path, and I think it's awkward to say pause and when you're going to go in July. Why don't you go in June? It's awkward, but they're managing it. And I wouldn't make too much out of it. It's not the end. We're a long way from the end, and it's just a question of, are we going to end at 5.5 after two more hikes, or is it going to take more? We'll see.
Yeah, sorry if you can hear. We were talking about economic activity. There's a bunch of drilling going on outside of my apartment right now, so sorry if you can hear that. So do you think that what the Federal Reserve is doing will work, or how would you have them approach it differently?
Yeah. So it's not a matter of. So when I think about what the Fed's doing, I don't think the Fed is trying to manage our economy with their three crude tools: raising interest rates, short-term interest rates, the pace of quantitative tightening, and macroprudential regulatory rules. They lean against the economy when the economy is going too fast or too slow. And their job is to lean. It's not to direct. It's just to be a counter force to what's happening. And so I think they will do what they think is right to achieve their mandate by leaning against the economy. And they'll do what it takes. And if it takes no more cuts, that's what it'll be. And if it takes, stronger use of their tools, that's what they'll do. I think it's a longer battle than most, but we'll see.
And in terms of, this will be the last question, but I am curious just like on the path that you see for, because you've written so many great papers about it, but this path that you see for inflation and how the Federal Reserve is managing it, like how long do you think we'll be driving along this inflationary road?
So mostly, I think that there's two paths, which is they've done enough, um, and then the economy will respond slow. Inflation will come back to target, and then that's sort of the they've done enough path. And then there's the higher for longer path, and we know what that'll look like. They'll have to do more as the economy hasn't responded. But one way or the other, we get to that path in which they have done enough. And I think the real question for markets will be, there's an expectation that once they've done enough, they're going to quickly cut interest rates. That's what's priced into many markets. And I think that's the big mistake that markets are dealing with, that even when we've killed inflation, we're not going to risk restarting inflation unless there's substantial economic pain occurring. So we're not going back to zero interest rates. And the path from where we are when we finish, whenever we finish, the path from when we finish to normal is going to be slower and end at a higher level than expected, because these inflationary forces that have been in place for 40 years of globalization have been muted lately by the deglobalization trend, and that'll keep support in the on inflation and create additional future inflation volatility. And so I think they'll be cautious in terms of cutting once they begin that phase. But whether that's next meeting where we peak or some meeting in the future, that I'm not sure about. I would think it's longer than most, but we never know.
Yeah, that's definitely the big takeaway, it seems, of the past few years. Who knows what's going to happen next? This has been really great, Andy. Thank you. And you're on Twitter at Damped Spring, but where else can people find your work?
Dampspring.com is where all of my historical archived Damp Spring reports are, and those are the two best places to get me. Though I also offer at Two Graybeards, at the letter two, Graybeards with an A, something for high net worth investors or people that are paying an investment advisor a lot of money and really not understand, not communicating well to them. And so, if you're looking for help, just sort of with lingo and what's going on in the world, at Two Graybeards is a good place.
Well, thank you so much. This has been really wonderful.
Pleasure. Anytime.